What have we seen in terms of banks being able to assess those funds from the cash reserve ratio, and to what extent are we seeing that benefit the real sector?
Thanks. I think there's been a lot of excitement across corporates once the announcement was made. We've seen a lot of our clients reach out to us to get clarification as to how to go about accessing it.
Yeah.
At this stage, there's a lot of applications going into CBN, and we're quite hopeful that over the next couple of months, a lot of those applications will come to fruition.
But is it typically greenfield projects? Is that the condition, or do we have brownfield expansion plans as well that will qualify for this?
There's a lot of expansion plans and greenfield focus, without a doubt. I think the policy, when it was issued, there was a subtle, actually very clear point around no refinancings.
Yeah.
So if you take that out, the focus would be on greenfield and actually capital expansion for corporates in that sector.
Well, let's focus a bit on loan growth in general, especially to the real sector. It's been a tough year, even though we've seen GDP growth pick up slightly. Give us a sense of lending towards the real sector. Is it safe to say that it's actually declined?
I think that's a very fair statement. Compared to previous periods, we've seen a very pedestrian growth in loan book across the banks. Half-year results showed that evidently. Only a handful of banks recorded loan growth. I think, to your point, we've not seen the kind of broad economic growth that we expected, and that has affected general lending into the sector. There's also a paradox, given that since the year started, rates have been somewhat low, comparative to previous period, and you would have expected that should have spurred a lot more demands for loans. So that tells you that maybe broad capacity, broad demand is not there, and if that's not there, corporates will not be looking at expansion. As a matter of fact, they'll be more focused on managing the existing competitive landscape, making sure they're competitive, rather than expanding.
But to what extent are we seeing an elongation of the tenors of loans to real sector lenders?
To a large extent.
Borrowers, right?
Yeah, to a large extent. Coming out from the recession of 2016, late 2017, what you find is that if your demand is not growing and you have a huge chunk of debt, you have to think about restructuring your balance sheet. So you've seen a lot of elongation of tenors. Companies that have the capacity will bring in rights issue, do rights issue, bring in equity to deleverage their balance sheet and then position themselves for the growth that is meant to come. So that has been, excuse me, that has been one of the key areas where we've been doing a lot of transactions.
But on the debt side, not equity now, are we seeing loans perhaps moving on to 5 to 7 years?
Absolutely.
I know that is what the central bank is hoping to achieve with this program.
Yeah,
so this is happening already.
It is happening. You're getting, if you're in the developed manufacturing sector, you would probably get more. I mean, if you have the right business plan, you should be able to get 3 to 5 years, maybe 7 years, and that has been happening for a while. Yes.
All right. So let's talk about the outlook, though.
Yeah.
We've seen some modest improvement in economic activity, but then as you mentioned earlier, we have seen loan growth decline. What's the outlook for investment activity across the real sector, and what can you point to as a potential catalyst going into next year?
The outlook is, given the election cycle coming up, the outlook is not that positive. Generally, when you get into the election cycle, investors are quite conservative, and they'll wait for the election to blow away before they decide on investment decisions. I think the catalyst will be, one of the key catalysts is seeing where the new minimum wage debate would get to. Perhaps that would spur demand in the short term and prompt corporates to have more confidence in going ahead with their capital projects. And the piece and the way the election goes is also a key catalyst. If you have a big project, you're definitely going to wait for the elections to pan out before you go put $100 of millions into that investment.
So to the point on the minimum wage, clearly consumer demand is something that a lot of companies are looking at right now as a big concern, because I continue to hear that this year, that the consumer's pocket is really challenged. Moving into next year, given the type of economic activity we're seeing right now, Are you suggesting that perhaps the minimum wage, the introduction of the minimum wage is perhaps the only potential catalyst to prop up consumer demand?
It's certainly not. You expect policy direction to spur a great part of that. Minimum wage, as far as I'm concerned, is a short-term blip, and there are implications for it. If the economy is the way it is right now, and you increase minimum wage, I would expect corporates to downsize. That's the natural effect, if demand remains low. So you need more than the minimum wage. You need strong policy directions, investments, incentives to actually spur growth. And so it's going to be a combination of many factors. Minimum wage is just an element of that.
And if we focus a bit on the multinationals, how are they viewing Nigeria going into next year? Because there's always been this argument that foreign direct investment is long-term oriented. It doesn't pay too much attention to maybe some weaknesses in the currency and potential changes in politics. But do you get the sense as well that that is still the case in Nigeria? Are we seeing firm interest, strong interest in the country going into next year?
We're certainly seeing it from clients that we cover. There's been a lot of interest. I would say a lot of it is of questions. There's been a lot of questions around where are the concessionary funds? How can they get single-digit rates? That has been the bane of many producers. And when you speak to multinationals or anyone looking into the market, they want assurance that at 25–30% interest rates, it's not going to work for many of the investments they're looking at. So they're also looking at long-term concessionary fund, and that has always been the cornerstone of their conversations anyways.
Certainly.